Hello, this is Jeff Clark with GoldenCare USA. We're going to be going over the Mutual of Omaha's new long-term care insurance rates. Kind of a neat little webinar. When the rates were adjusted, they call it the rate refresh, which we've all come to know that usually means rate increase on new policies. We got digging here. We kind of looked at where the rate increases were the most meaningful. Some parts of the 3% compound, for example, married couples. So we kind of wanted to break that apart and kind of see what we could do to still be able to design some affordable plans. So we put together a webinar kind of showing the strength of the rate increase, some areas that it's really noticeable, and some areas it's not so noticeable. So we put together a webinar more or less to show the difference there, how you can still quote a good plan for your clients and not break the bank on premium. My name is Jeff Clark, Regional Director here with GoldenCare USA. I do want to thank you guys for coming on board today. Shouldn't be a real long webinar. It's about a half hour or less. So let me see now. It's not moving along. Okay. So first of all, this is the newer rates that are out. You'll notice that there is, I think the number here, 32 plus the additional, 1, 2, 3, 4. So we're about 37 states. There's still a handful that are on old rates. So take a look at this. If you're in one of those states that are still on old rates, like California or DC, for example, Indiana, jump on the opportunity. So as of 9/1, the listed states, the 32 states there went up, and then they added another round October 19th. Kentucky, Maryland, Massachusetts, Pennsylvania, and Wisconsin. So that's where the rates did go up. So here's a map again. Changed November 1st, changed September. So you still have a handful of states that are on old rates: the Dakotas, Montana, Florida, of course. So if you're in those states, I strongly suggest any of those clients that are on the fence, it's time to maybe tell them to go ahead and apply, especially if they're married couples. So what was the increase? Well, first, one of the big things to me, what they changed is, the first day cash benefit is 25% of the home care on, used to be 40%. Most return premium options currently offered by any other carrier, unparalleled flexibility, over 69 inflation options to choose from. So we still have a great product here, Mutual of Omaha. They did alter a couple things, but other than that, you've still got some of the most flexible benefits. You've got one of the most, it's still the Cadillac in the industry, even with the adjustment they made. They hadn't changed rates in almost 7 years. And so really, it was probably long overdue based on what other carriers are doing. But, Mutual of Omaha is the Cadillac, number one in the industry. So still, if I have healthy clients that are coming to me, brokers that are bringing me clients, if they have no health problems and they're looking to get the most bang for their long-term care insurance premium buck, I'm looking at Mutual all day long. So Mutual of Omaha is committed to this market. They're very committed to the senior market. They're number 2 in Medicare supplement sales. They're strong, stable, secure. So I couldn't say enough about our partner here with this. Mutual of Omaha is still the way to go. But they did adjust their rates. So what we did here again is we called it Crack the Code. Well, we got our private investigator, me and several other directors here, Tom Randall and John Randall, and we broke down the things. We looked at every age bracket, every variable, and we tried to find the areas where we could help navigate our agents to still be able to quote things that were very affordable and not give up too much benefit with the newer rates. So that's kind of the premise behind this. So we're just going to review the short and fat. This is a theory that we've used for years, that, it's always better to kind of shorten and fatten those policies up, knowing that 90% of care happens the first 2 years. 90% of claims don't go beyond the 2 years. So we really want to emphasize that benefit in the short run. We don't like long, skinny policies. So we kind of go over that a little bit, and then we're just going to go over the, shorter and even fatter to get around the rate increase. Without further ado, let me kind of tell you what I'm explaining here. So this is a slide that I have used for years. I always told people you don't want to do a 5-year plan with a 5% compound and $270,000 pot of money. So what I'm showing here in this one is long, skinny versus short and fat. So in other words, the policy maximum, agents have always gotten hung up on a 3-year plan, a 5-year plan. This is still a pot of money of $270,000. So when I compare long and skinny versus short and fat, I'm still going to use a $270,000 pot of money, but instead of offering a monthly benefit of $4,500, I'm going to increase that to $7,500, and it's then going to be a 3-year benefit, right? Again, don't get hung up on years. It's still a pot of money. So all I've done here in this short and fat example is I just increased the monthly amount. I dropped the assisted living, of course. 50% of 750 is pretty close to where you were. We used 3% inflation instead of 5% inflation. And so all together here, we saved a significant amount of premium here, almost 30% in premium. And in my opinion, we made a stronger policy. This is for a 60-year-old couple. So you got to figure average claims happen around 81, 82. So 20 years down the road, the short and fat design outperforms the long skinny. You're looking at $13,500 benefit versus 11. Now, at some point, the long skinny 5% will catch. So, kind of break even around years 29, 28. So if you're selling a 45-year-old couple, I don't sell a whole lot of them. I think I have 660 cases on the books, and I very few are in their 40s, unless it was a worksite scenario. So for a bulk of what we're selling, this 3% short and fat, was just a much better alternative. Because also, when you took $4,500 down to a local nursing home, we know the nursing homes are $7, $8, $9, $10,000, $12,000 if you're on the East Coast. So that was never getting it done. People have insurance, and with that skinny benefit, they're getting hit with $4,000 or $5,000 a month out of pocket. So bumping that up to $7,500, sure, maybe it's only the last 3 years at that rate, but that's when most of the claims happen. Remember, 90% of claims don't exceed 2.5 years. So you really want to shorten it, fatten it up. So with this premise, they change the rates again. Matter of fact, I put this long thing together on how to get around certain rate things, and then they change the rates here. But so now what I'm doing is I'm going even shorter, even fatter for the sake of this argument and showing you guys how to get around those rates. So here you have long skinny, here you have short and fat. I want to call this one shorter and fatter. Just didn't fit in there on the top of the screen. But so what I've done then is, again, look at 20 years out here as the average claim. And folks, listen, I do know that the crossover points, can start catching you at years 30, 35. And I've always been a believer that the most important time to have long-term care coverage is going to be when that couple just retires at age 62 or 64 or what have you. Last thing you want is at age 67, one of them to have a stroke and wipe the other one out, and the other person has to, live like a pauper for 20 years. By the time they reach 80, 90 years old, they've lived their retirement. The need for long-term care coverage starts to diminish. And so what I'm doing is I'm emphasizing the first 20 years of this coverage, having good, solid coverage. And I'm also just trying to save them some premium. If I go to a 60-year-old couple and with the new rates, if I'm going to propose them this long, skinny 5-year period, $11,488 for the 60-year-old couple. That 60-year-old couple is probably not going to buy. It's just too much money. Then I do the short and fat. And again, this is kind of the main emphasis of where Mutual of Omaha's rate refresh was affected, is on these 3-year plans. Maybe they were onto us because we sold a lot of these 3-year plans with 3% compound. That was what GoldenCare is a marketing office who sold a very large percentage of Mutual of Omaha's long-term care. So maybe that's the area they realized that they're getting too much. So that's there that affected the rate increase. So then we took it a step further on this one to the right, and I went, to a $270,000 pot of money now. But now I moved that benefit all the way up to $10,000, and I dropped the inflation to 1%. Again, 50% assisted living. That's still $5,000 a month. That's more than we had over here at the long skinny. So the assisted living benefit's actually higher. The monthly benefit is more than twice as much. But yeah, the pot of money is still $270. Okay, and that's going to grow at a slower rate. And then again, that's the crossover I'm talking about. That yes, this thing won't be as powerful, won't have the length in it when you get to age 90. But again, I can tell you stats that claims that start in their 90s are even shorter. So because people are older. So I yes, you're going to notice some give ups when I do these. But look at these 20 years down the road, that monthly maximum. Yeah, all pretty comparable. 11,000 versus 13,000 versus 12,000. But look at the premium. The premium is 50% of what it is with a long skinny. Okay, so this is the concept we're going to utilize. So a lot of warm up on that. So let's go ahead and take a look at it. So what we did here is we put together 3 plans. In other words, I wanted to take a look at where that rate increase, and we ran a bunch of rates on every area, like I mentioned earlier. Married couples, singles, 1%, 3%, 5% compound. So this is the areas. In other words, I think this first example is a single female. So those rates went up about 19.6% on single females. So I pulled that one out, and I used a 60-year-old female for the example for today. Then I found, again, on the apex, if you will, the highest places in all the things we could find. These are two of the highest areas. Married couples, 4,500 plan. This is a 6-year plan, 43%. 4,500, $324,000 pot of money. We use 3% compound. So those rates were 59.65, and with the new rates, 85.49. Pretty significant. And if you look over here, a 55-year-old couple, it was 33.91. Now it's 49.69. That's an increase of 46%. So at first, brokers were calling us, agents calling us saying, "Boy, Jeff, these rates went up, almost 50%." So we had to start breaking it down. And so these are the three areas I want to look at today for comparison reasons. So the first one is going to be this female. This. How do we get rid of some of the sting of this 19% rate increase? Well, what we're going to do is we're going to do a short and fat instead. So if I were to look at a benefit here of $4,500 a month, $270,000 pot of money, 3% compound, 5-year benefit essentially is what this works out to. Well, at this rate, you've got a annual premium of $48.52. Now at the new rates, that jumped up $1,000 to $58.08, or a 20% increase, like I mentioned before, that 19.6%. Okay. So, and here's what your benefits are, by the way, in this particular plan when you're using a 5-year benefit, 3% compound. Now the benefit's paying $6,000 to $10,000 and $4,500 to $6,000 to $8,100, 20 years come claim time. Pot of money from $270 grows to $363 to $488. So what I'm going to do then is I'm going to go ahead and use a $10,000 benefit. I'm not going to put any inflation in there, and I'm going to bump that pot of money up to $500,000. Okay, now this essentially ends up being a 4.17. I'm going to cut the assisted living in half. Remember, I had 4,500 here before. Okay, I'm going to double that, more than double that, up to 10,000. Okay, so in the assisted living, then of course, it ended up being $5,000 a month. Before it was 4,500, so that's higher. Okay, and I put this policy maximum. So again, 10 years from now, right now I'm paying 10,000 versus 500, which again, I want to pause there. That's significant. If this person has a stroke at age 71, well, guess what? My policy is going to be paying 10,000 compared to only 6,000 in the other design. I'm going to have a pot of money of 500,000 versus only 363. 20 years down the road, the pot of money is equal out. I'm still above on that 10,000 per month. Matter of fact, it doesn't cross over, I think, till years 27, 28. So they're almost 90 years old at that point. The premium, by the way, this is less than what it used to be. So not only did we take the sting out of that rate increase, we actually showed you a way to charge less premium, even with the higher rates. So again, we're using what Mutual gave us as far as rates, how to hit those sweet spots to keep the premiums down. So pretty neat little thing there. So on this one here, we've actually lowered the premium, given pretty much the same benefit, much stronger benefit, in my opinion. Okay. Then we have the same single female. At this point, we're going to just do a little different option here. Here, we're going to do an $8,000 a month benefit. We're going to put 1% compound in there. And notice the premium here, it's about the same as what it was before, $48.52. This one's $48.92. It's the same premium, 0% increase. And so this one does have some growth in it. So what do the benefits look like? They're higher now. They're higher in 10 years. They're higher in 20 years. Pot of money. Well, here's where you see that length then. You start getting to years 20, maybe the pot of money gets to be a little smaller. But again, this is putting them out at average claim time. That extra amount here, because 90% of claims don't go beyond 2 years, don't worry about years 4, 5, and 6. They're likely not going to get there. Okay, but they're at least going to be covered much more adequately those first 2 years. Much stronger plan design. Okay, so this again, same premium. Let's do it one more time. So this time I'm going to go actually to 2% compound, give them some more growth. Now I'm going to lower that benefit down to $5,500. I'm going to do the assisted living at 75%. So again, it's comparable to that $4,500 that we had before. Okay, so I'm still comparing the old rates, or the old policy design. I'm going to bump this policy maximum up to $290,000 because we're using 2%. And what does this look like? So here again, this is it's the same premium as the old rates was. So again, I'm trying to eliminate this 20% higher rate. So instead of being $58.08, I've got a premium back down to $48.99. So there's really no net effect of an increase with the new rates. And my benefits are, again, pretty comparable. If you look at 10 years down the road, 6,000 versus 67. 20 years down the road, 8,100 versus 8,100. Pot of money is a little bit weaker. Again, I think I've addressed that. I'm not worried about years 3, 4, and 5 when they get to be their 90s as much. Again, we're trying to do something to save on premium. You can go ahead and just sell them the $58.08 if they can afford it, and if they're not price sensitive. So these are just mere suggestions to try to keep premiums down. The best way to go would probably go ahead and sell them the $58.08. Most of my clients were premium sensitive. They didn't very often just give me a blank check and say, go ahead and design what you'd like. I had to be more creative when I'm designing things for them. And I think that's still pretty true. So let's go to the next example now. This is a bigger one. Now, this is when we had a married couple at age 60. All right. Now, this is, so we're going to start again with the base, the long skinny, $4,500 a month, 6-year benefit, 100% assisted living, 3% compound. This is where the rates, remember, went up 43%. So, and this is when brokers were calling me panicked, saying, Jeff, these rates are so much higher. What am I going to do? Well, I walk people through when they call and say, well, let's just go with a shorter, fatter policy. Let's lower that inflation or take the inflation out. And let's break this down. So again, this is for a 60-year-old married couple. So instead of having an annual premium of $85.49, I put together something that was $61.76. Now I know it's 2% higher. It's basically a wash from where you were before. Pretty close to the same premium. But I went ahead and just jumped that from $4,500 a month on up to $10,000 a month. Then I cut the assisted living in half, of course, because that's $5,000 a month benefit. It's kind of what we had. A $500,000 pot of money instead of $324. And I'm going to have no inflation in there. So again, I like the fact that the first 20, 25 years, my monthly amount's higher than this long skinny design. Because again, if they go on claim, most of those claims happen the first couple of years. At $4,500, or if they claim, at 5 years later at age 65, they've only got a $5,000 a month benefit. And that's not going to get anyone paid anywhere in the country. Maybe in Shreveport, Louisiana, that might cover the whole bill. But anywhere else in the country, you're looking at $7,000 a month to $10,000 a month. And so these people are going to have a policy. If you're looking at design number one over here, long skinny, for $85.49, they're going to have a policy that doesn't even pay their whole bill. They're going to be hit with $3,000 a month of out of pocket. After 12 months, that's $36,000. And they paid more for this to begin with. So again, lower this premium down by dropping the inflation out of there, increase your policy maximum, and your monthly benefit. So those still break out. Again, you're coming out ahead here on most categories. Again, the length of plan, the overall, the pot of money, you'll start to kind of lose on, but you can split this difference. So the next one here, I think what we do is, I'm going to split the difference. So this is 11% higher than it was before. Not quite as low as $5,900, but certainly not as high as this $85.49. So I'm going to propose one with a little bit more benefit. Okay, so I'm going to do $7,500, and I want to have that growth, so I put 1% in there. Okay. So now my premium again is $66.49. I'm getting some growth on my stuff. So now it's $7,500. 10 years from now, it's $82. 20 years from now, it's $9,100. And as opposed to $6,000 or $8,000. So this policy nets or catches itself out about year 25 again on that amount. The pot of money now is closer. And so for just 11% more premium than old rates, I've got a thing that's pretty comparable. So we don't have to do this 6-year, 3% compound in married couples. I've eliminated about 32% of that rate increase. Okay, so I've, again, using the higher amounts, higher policy maximums, and lowering that inflation. One more example, same couple. So we went to 2% here. Again, I'm getting a little redundant here, but I think you guys are following the points here, or I hope you're tracking with me. So this one, we weren't looking at saving all the rate increase. We're going to go ahead and do a $5,500 a month benefit. We're going to do a $350,000 pot of money, and we're going to put 2% in there. Of course, I'm going to do 75% assisted living now. So this is a 5.3-year benefit if you look at it that way. But okay, so how does it compare? Well, now it pays $5,500 versus $4,500, $67 in 10 years, and $8,100 in 20 years. Pots of money are pretty close. A little less in 10 years, or a little bit more in 10 years, a little bit less in 20 years. Starting out a little bit higher. And this is a 22% higher premium. So really, if you can't get to 5,900 anymore, either go no inflation, for almost a net effect, just do the 500,000 and 10,000, no inflation, or anything in between. 1% with a little lower amount, maybe 2% with even lower amount, and lower those so it grows. Maybe longevities in the family. So if you have people that tell me that their parents are both 96 and 95, well, then maybe I go with the 2% option here and do this a 2% growth in it then, so it keeps growing. Okay, last example I want to show you, and this one, I'm arguing everything at age 60. So the reason I went with this design here is at age 55, we have a little bit more time out. Now we're talking about, 30 years later for claims. So now I want to show you benefits 30 years out, to be fair. And just again, we're trying to save on premium and trying to design things that are affordable, but that still give your clients a meaningful benefit come claim time. Okay, so something has to give with these new rates, right? So we're just trying to find an area that gives you the biggest bang for your buck, the most meaningful, benefit for as little premium as possible to try to compare to where we were before. And again, I think we do a pretty good job here. This first example right out of the chute for this 55-year-old couple, though there is some policy maximum give up here, but again, I'm getting rid of that whole 46% increase. So the old rates, a plan design like this, a 4,500-year plan, a 4,500 a month plan, 3-year benefit, 100%, 3% compound, married couple. So this is the apex. This is the hardest hit rate refresh in Mutual Omaha's new rates. 46% increase from before. Well, I'm just not really selling plans designed with that design anymore, because that's where Mutual really attacked. They hit the tax sounds strong, but that's the area that was affected more. $4,500 a month, 3-year benefit, 3% compound. So I'm going to take that thing. I'm going to knock it down to it's a 2.21 year benefit. It's a $10,000 pot of money. So again, I'm going to double that. I'm going to take the pot of money from, the monthly maximum to $10,000, the pot of money, the policy maximum to $265 as opposed to $162. And I know I'm a little bit weak on that backside, but remember, I'm more emphasizing the first 2 or 3 years of care as 90% of claims, right? So I'll give you that when these people get to be 85, 90 years old, there's a little give up on the backside. But 30 years out from now, when they're 85, my benefit's pretty comparable. And if they go on claim any time before they're 85, age 72, look how much more benefit they're getting to cover these costs, so they're not out of pocket so much. Okay, so it's 10,000, obviously no inflation, 10,000, 10 years, 20 years, 30 years. Okay, the pot of money is going to stay at 265. So somewhere around year 17, 18 here, you're going to lose out in the pot of money, but and you can do a different design in this. You can do $9,000 a month benefit and maybe a $280,000 pot of money. I mean, there's just so many different ways to do this. This first example is just saying, look, I'm going to gut the inflation completely. I'm going to keep the premiums back where they were. And I'm going to try to give them a meaningful benefit there, $10,000 and $265. So another option here is to kind of try to, this is about 11% higher than the old rates, but I've taken 35% out of that rate increase by only having a premium of $37.73 as opposed to $49.69. Okay, so by doing this, I went to $8,000. I did 50% assisted living here, growing at 1%. I did a pot of money at $200,000, growing at 1%. So what does that look like? Again, now I have more benefit. I'm starting out at $8,000 and $200,000 versus $4,500 and $162. My 10 years down the road, my monthly amount is $6,000 as opposed to almost $9,000 with the shorter, fatter. Pot of money is about equal. 20 years down the road, I'm at $8,100 with this plan. I'm at $97 with the short and fat design. Again, my pot of money is getting a little bit more behind. Maybe you're losing out on years, the 2.5, 3.5 years, 4.5 years. And finally, 30 years later, it's 10.9 versus 10.7. It's almost a net. Again, average claims happen at 82. So this puts about 3 years beyond that. And my benefit's finally breaking even there 30 some years later. Again, the premium, it's not $49.69. That's $5,000. I would argue that people are more likely to buy something that's $37.73 versus $5,000. Okay. And again, you can explain these benefits if you need to maybe bump that pot of money up to $250,000 so the benefits get a little closer if that's a concern of theirs. Remember, you have some money to play with. We're just trying to save some premium here. Okay. Another way, So it's kind of what we do with all the plans now. Where can we give up premium where it doesn't really affect our benefits, that much? What can we give up in these new rates? And that's kind of what we're doing here. The last example, of course, is going to be, this is for that married couple at 55. So remember those rates are at 46%. Well, this one, I'm just going to go ahead and do the $5,500 benefit, 75% assisted living, 2% compound to have that growth. Again, this is someone with longevity in their family. Maybe they've got a couple 95-year-old, parents, so there's a spouse. They're expecting to, okay, I'm gonna go ahead and do 2% growth. You'll see that these dollar amounts again net out 30 years later. Pot of money is not too far behind either. So really, instead of a premium of $49.69, I'm gonna, $5,000. I'm gonna give them a premium of $42. So excuse me, I'll go back. Okay, so this is another alternative. So you'll see for all three of these examples, if I'm looking at maybe, trying to get the exact same premium as we had before, long-term care was too expensive to begin with, I really need to keep my premiums down, get rid of your inflation. Go with higher amounts. Okay, if you're somewhere in the middle there, I still want to have some growth, use 1%, use 2%. What we have to try to avoid is using 3-year plans and 3% compound. So we have to be a little bit more creative with our rates now and how we structure plans, how we put them together. So in a nutshell, that's the kind of premise of today, is cracking the code. Then I was asked when I put this together and kicked it around the office, what's an actual, for just an absolute rule of thumb number that we can always use? Where'd it go now? Boy, okay. Well, let's back up. Okay. So this is what we came up with. So where to start? So you're quoting a new plan now. You haven't broken down. Maybe you haven't been, following everything I just said here. Maybe it's still a little bit. And by the way, if that's the case, just give us a call. I'll walk you through how to do these kind of new proposals or new rates. But whatever you were going to quote before, so if it was, I don't know, a $5,000 a month benefit and a $100,000 pot of money, my suggestion is this: bump the monthly up by 1.25, bump the policy limit up by 1.25. And so raise the monthly benefit 25%, raise the policy maximum 25%, and cut your inflation from 3% down to 1.5%. So I was asked to kind of give a starting point, 1.25, 1.25, 1.5. Meaning, just take whatever you're going to do and bump up the monthly, bump up the policy limit, and lower your inflation. I like this area here. This seems kind of a sweet spot in the new rates, 1.5% inflation. So just start out with a little higher monthly and a little policy maximum, use 1.5. You'll find that the rate refresh isn't that big of a deal anymore. So that's Crack the Code. I want to thank you. I'm going to leave this number on here for a little bit because you can call after the webinar. Of course, we do webinars where we don't have the interactive or live questions anymore, but 800-842-7799 is our number. Please call if you have any ideas. Maybe you're quoting a case and you want to just play around with exactly what we just did. I think most of the directors, we're all available here. Actually, I have another meeting I have to be in for about 20 minutes, but I'll be available here later today as well. So if you have any questions on that, give us a call, 800-842-7799. I think we'll send you a copy of this presentation and some other goodies. I forget the variety of stuff that we sell, but some of our tools and programs, updates about future webinars. I think a copy of this one will be sent to you, a copy of the slides, the presentation. Of course, all of our presentations for this topic or any of the topics that we do, product selling, hybrid versus long-term care, they're all in our pre-recorded library at GoldenCareAgent.com. Great resource. We've got all of every product we have product training on all of our products we offer. So a lot of great tools. So if you haven't been on GoldenCareAgent.com, I suggest that you poke around on there. And let me real quick here before I close, I'm going to see if any questions were asked. Maybe I have one. Bear with me. Okay, I've been asked here by someone, are we avoiding extra benefits such as shared care, etc., and because of cost? Not so much. I'm just for comparison reasons on that. If I had to throw those riders in there, it would put the same amount on there. In other words, it's a 12% increase to do a shared care for 60-year-old married couples, for example. So that 12% will reflect on both plans. I think I was just trying to keep it simple. Is the reason why I didn't want to pollute it with a bunch of different riders. I'm trying to keep it very basic for comparison's sake, so folks can see, how to navigate on the rates. But certainly, you can add shared care. You can add all the same thing that I just presented to you will bear out. Some of those riders are age banded, but most of them aren't. So it was just for the simplicity. It wasn't to keep the cost down so much, which naturally the riders do. If you don't put the riders, it does keep costs down. But it was just to keep it simpler to see, I guess, without complicating it. And then also I have a request here to send out the webinar screens, etc., which we'll automatically do. So I think that wraps it up. So, folks, I just want to thank you for coming on board, spending some time with us today. We do appreciate it. And we'll get you a copy of this. And again, my name is Jeff Clark. So thanks a lot for coming on board. And give us a call if you have any questions. I'll give you that number one more time, 800-842-7799. Matter of fact, I'll leave that on the screen for a couple minutes for you folks. And thanks a lot for coming on board. There's the 800 number. Well, hopefully good luck selling, and we'll talk to you soon.